Investing in dividend-paying stocks is a smart way to create equity and maintain a steady income stream. Although investors are taking on more pressure, there is also the possibility of better returns. Finding success in these investments isn't rocket science, although it does necessitate knowledge of certain fundamental concepts. To help you with dividend investing, we prepared 10 tips that any savvy investor should be aware of. Before we reveal them, be sure to show us some love by liking this video and subscribing to the Upstep Financial channel, the only YouTube channel you need to step up your financial game. To further understand the main course of this video, let us define first what dividend investing and dividends are. Dividend investing is the practice of purchasing dividend-paying stocks to earn a consistent income stream from the portfolios. This money comes in comparison to the gains in your portfolio as the value of your securities or other investment rises. On the other hand, a dividend is a payment of a portion of a company's profits to a class of owners decided by the company's board of directors. As long as they own the shares before the ex-dividend date, common shareholders in dividend-paying firms are usually eligible. Now that we know their definitions, let's dig into our top 10 tips when investing in dividends. Coming in at number 1, assure dividend safety. One of the most critical factors to look for when deciding where to invest or buy a stock is dividend protection, usually determined by the dividend coverage ratio. The dividend coverage ratio is a statistic that determines how many times a business will pay cash dividends to its shareholders. If the stock dividend coverage ratio is high, the company is likely a secure dividend investment option. Companies that pay out 60% or less of their earnings to shareholders are the ones to invest in. A business that makes $100 million and pays out $30 million in dividends, for example, is a better investment than one that earns $100 million but pays out $90 million. Check to see if the company's profits and cash flow are stable enough to continue paying dividends. Number 2, choose dividends with a high growth rate. This approach involves purchasing shares in firms that pay lower than average dividends but are quickly growing. Because of the rapid expansion, the company is usually willing to pay dividends equal to or more than what they would have paid if they had used a high-yield approach. Number 3, check if the dividend stocks are qualified. When investing in the dividend stocks as a shareholder, search for qualified dividends. This will allow you to apply for additional tax benefits. Qualified dividend securities are kept for a longer period, at least 60 days, and benefit from lower tax rates in most cases. For a dividend to be deemed eligible, the IRS has 2 major requirements. A U.S. company or an international qualifying agency would have charged it. The stock would have been kept for at least 60 days in common stocks and 90 days in the case of preferred stocks. Number 4, choose Dividend Aristocrats. Many new dividend investors begin by investing in Dividend Aristocrats or companies paid and raised by their dividends for 25 years or more. The first 26 companies on the list were added in 1989, and the list has since expanded to include more than 50 companies. Dividend Aristocrats are a perfect place to start for new investors because they've proved to be long-term growth structures capable of maintaining and raising dividend distributions. Number 5, invest in stable industries. This is an often neglected part of dividend investments, differentiating between a good and a poor investment. Consider the past of the market and the present environment. For example, many investors believe that healthcare facilities will grow in the next 2 to 3 decades as the massive baby boomer population ages and needs more medical attention. This suggests that healthcare securities are more able to withstand market volatility than other forms of stocks. As we approach the second half of our tips in dividend growth investing, let's first have a recap of what we have already discussed. To maximize the growth of your investments, you must assure dividend safety. Select dividends with potential growth, verify the stocks you are about to invest in are verified, choose Dividend Aristocrats, and invest in stable and healthy industries. Also, don't forget to smash the like and subscribe button if you hadn't done that yet to support the Upstep Financial channel. Without further ado, let's continue with our dividend growth investing tips. Coming in at number 6, choose dividends with high yields but don't fall with dividend traps. A dividend yield is a formula that calculates how much income you will receive, or how much money you will pay, for any dollar you spend at the current price based on the current dividend rate. Divide your cash payout by the share price to get the dividend yield. When it comes to saving, you want to search at high-yield dividend-paying stocks, but be cautious and escape dividend traps. Examine the dividend rates of other firms in the same sector to ensure that they are comparable. A business with a high dividend yield may seem to be a good investment, but do your homework before investing. A high yield may often mean financial trouble. Number 7. Go for dividends with growth potential. Remember that the best dividend stocks offer some growth, even if it isn't as high as those high-flying tech stocks. Assets that appreciate are valuable to any investor, but dividend investors place a high premium on growth. Since inflation erodes a dollar's purchasing power, dividends must be higher in the future to have the same relative value as dividends now. Since stock prices typically increase with inflation, equity holdings are an integral part of retirement portfolios. Retirees who only have cash and bonds in their portfolios are at risk, particularly if they want to live off their investments for decades after retirement. That's one of the reasons dividend aristocrats are judged for their ability to increase payouts rather than merely maintaining them steadily. Dividend buyers should think about stocks that aren't stagnant, leaders in sectors that are growing at or above the pace of the overall economy will be excellent income stocks. Companies that penetrate neighboring regions shrewdly are also appealing prospects. Number 8. Don't pour it all on a single company. There's an excellent case to be made for investing investments in a small number of stocks or focusing on a single business segment. If the businesses or markets you've chosen have a strong track record, it bodes well for your dividend income in the future. On the other hand, this may be a challenge during a downtown auction. Spreading your funds through several dividend-paying investments diversifies your portfolio, thereby reducing risk. If dividends are cut in one area of your portfolio, the impact may be less noticeable if the majority of your portfolio performs well. Number 9. Recognize when to hold or fold. Warren Buffett, the investment guru, believes in taking the long view of investing, but he still knows when to cut his losses. There's a delicate balance between holding on too long and hoping for the gamble to pay off when it comes to dividend stocks. There is an elementary mistake to make when buying stocks that seem to be a good deal on the surface. The issue arises when the company fails to meet its growth targets. It's important to spot when a stock is falling, but you still need to know when to act and when to wait. Number 10. Reinvest your dividends. Because of the effect of compounding, reinvesting dividends will boost your long-term returns. Your dividends help you buy more stock, which raises your dividend the next time, allowing you to buy still more stock, and so on. You have the option to reinvest your dividends. Some businesses, on the other hand, provide dividend reinvestment programs that make the transition easier. These DRIPs, as they're called, use your dividends to buy more stock on your behalf. Using DRIPs has several advantages, including commission-free trading, discounted share rates, and fractional shares. One of the many advantages of dividend reinvestment is that it allows you to accumulate money quietly. You'll still have a steady stream of investment revenue when you need to augment your salary, usually after retirement. One of the many advantages of dividend reinvestment is that your investment can rise faster than if you keep your dividends and focus exclusively on capital gains. It's also low cost, easy, and adaptable. However, dividend reinvestment isn't the best option for any investor. If you have any doubts or reservations about reinvesting your dividends, you can speak with a trusted financial planner. If you enjoyed watching this video, don't forget to leave a thumbs up and show us some love by sharing our channel with your friends and colleagues to help them in their financial goals. Again, this is the Upstep Financial channel, the only YouTube channel you need to step up your financial game. Thank you for watching, and we'll see you in the next videos.